It is Friday, May 8th, and the global financial market just slammed headfirst into an absolute wall of contradictory, high-impact news. A federal court struck down the president's tariffs. The monthly jobs report crushed Wall Street's expectations. One AI startup is suddenly closing in on a $1 trillion valuation, and U.S. warships are exchanging fire in the Middle East. If you're managing money today, you must decide whether to buy into massive tech acceleration or pull back and protect your capital from geopolitical fallout. To make sense of the noise, we have to isolate the signal. Everything moving the market right now comes down to three macro forces: geopolitics, the Fed, and the physical build-out of AI infrastructure. Let's look at the first force pulling on the market: legal roadblocks upending U.S. trade policy. A 3-judge panel just ruled 2-1 that the administration's 10% across-the-board tariffs are unlawful. They cited the 1974 Trade Act, stating the White House failed to prove a genuine balance of payments crisis. This ruling strips the president of his primary bargaining chip just 6 days before he walks into a high-stakes summit with China's President Xi. At the same time, Iran launched missiles, drones, and small boats at U.S. warships in the Strait of Hormuz. The administration quickly brushed the exchange off, calling it a love tap. 20% of the world's oil flows through that exact choke point. Downplaying the clash is a calculated move to keep energy prices low and secure a domestic economic win before an election. With his trade leverage neutralized and a critical summit next week, the administration is backed into a corner. When political leverage drops, the likelihood of a sudden, volatile policy move spikes. The second force centers on the resilience of the U.S. labor market. Wall Street expected an addition of 65,000 jobs. Instead, the economy added 115,000, a massive 77% beat. Unemployment held steady at 4.3%, and wages grew 3.6% year over year. The data points to a healthy labor market, completely lacking signs of distress. Because inflation remains elevated and the job market refuses to crack, the Federal Reserve has absolutely zero justification to lower interest rates. For investors, this removes rate cuts from the immediate timeline. The central bank needs economic friction to move, and right now there is none, forcing a total recalibration of standard investment strategies. While macroeconomic policy sits in a holding pattern, our third force is moving at maximum velocity: the physical build-out of AI infrastructure. Anthropic's growth curve is pushing toward a $1 trillion valuation. Annualized revenue is making a 5-fold leap, jumping from $9 to $45 billion. This is fueled by heavy capital. Google committed $40 billion and Amazon another $5 billion. We saw the hardware reality of this capital deployment in CoreWeave's latest earnings. The cloud company beat revenue targets, but their stock dropped 9% because they had to raise their capital expenditure forecast to cover skyrocketing component prices. These rising hardware costs confirm that AI demand is radically outrunning the global hardware supply. Big tech firms are now so desperate to secure that supply, they are offering to directly fund new, exclusive production lines at memory chip makers like SK Hynix. We are watching a hyper-competitive physical hardware supply crunch, one anchored in silicon and server racks rather than speculative software valuations. So here is the board. We have an overbought S&P 500 heading into a tense diplomatic summit, and a Federal Reserve that is firmly on hold. You will see fresh consumer sentiment and retail inventory data this week. It tells us about temporary tariff anxiety on Main Street, but it has very little to do with the heavy, structural capital flows moving the market right now. You can't buy private AI software giants like Anthropic directly. Your actionable strategy is to target the underlying infrastructure: memory chips, semiconductor equipment, and networking components. These three macro forces collide head-on next week. Critical infrastructure bellwethers like Applied Materials report their earnings on May 14th, the exact same day the president meets with Xi Jinping. Navigate the geopolitical noise. Keep your portfolio diversified to manage the risk. And if you have capital ready to deploy, the window for the AI infrastructure trade is wide open. To keep track of these shifts in the global economy, hit the subscribe button and drop a like on this video.